public programming like this one, and also to add materials to our collection. So we've added DVDs, we've added some downloadable ebooks, and we've also added some brand new books, which we wheeled in here tonight. So there's a mix of some of those brand new materials and some of our favorites back here on this cart back here in the back. So as you leave tonight, if you're inspired by what you hear and you want to grab something and read up on it this week, please take a look at those books and consider taking those home with you to keep working towards your own smart investing goals. Everyone should have a copy of this season's programs. There's a January through May 2012 brochure at your seat. You should have a survey, and if you would please fill that out. I've added a few different things to this survey, so if you're one of the people who's been to every single one of these programs, it's a little bit different this time, so take a look at it. And we've got some special programs coming up in January. We're going to start an investment club, and it's one, we're not going to invest together, but we're going to invest in our own education and in our own knowledge. So we're calling it the Monday Morning Investment Club. That is listed in your brochure, and that's a little bit different from the other smart investing programs we've had so far. And what we'll do with this is we'll meet at 10 a.m. On one Monday every other month, and those dates are listed. And we're going to pick topics that we are interested in, things that we want to learn more about in depth. So if you're interested in tonight's financial markets and you want to know more, we might pick that. If you're interested in insurance, we might pick that. So I really want this to be something that the people in the group come up with the topics that we're interested in together. And I'll work to plan speakers every other month for topics that we're interested in. The other program that we have is January 28th, and you have a special flyer for it. It's coffee and couponing. So if you're interested in what's become a much more a trendy topic, couponing, then please join us. We're going to have people talking about all aspects of couponing that afternoon. We'll have coffee. It's a free program. It's a panel of experts from our local area, so they can really talk specifically about locally where to get good deals. So that should be a really good program. Are there any questions before I introduce our speaker? Anybody? If you are brand new tonight, stop by and see me back in the back, and I'll have you register for the series, and I'll get your name and email address so you can be kept up to date via email about programming. And we've got a little giveaway for you too, if you have not gotten one before. All right, without further ado, I'm going to introduce our speaker. He has been with us from the beginning. Dr. Rauderkus, Assistant Professor of Finance at UAB. Tonight he's going to talk about financial markets, and we're going to learn about the risks and the potential. And I think you'll enjoy it. Hand it over to you.
Okay, well, good evening and Happy New Year. I'm glad to see that I still haven't been able to run you off, so that's good. That's good. That's very encouraging. So, as Katie said, this is the fifth installment of these talks, and we made it kind of up through all the preliminaries. So now we're, this year, was the beginning of the year, we're actually going to get started with talking about investing and talking about financial markets. So what I'm going to give you today is a quick overview over things, you know, what's going on. There is. Talking about risk and return. There is a relationship. Talking about just some of the investment products. Now just introducing you briefly to things like mutual funds, stocks, bonds, and so on and so forth. We will have separate sessions talking about mutual funds, talking about bonds, talking about stocks. And what drives market prices, and then also how are the markets regulated, because it's a highly regulated environment, and we do need to know some of the things and some of the players. One of the players in the regulation of financial markets is one of the sponsors of this program, the FINRA. FINRA is what's called a self-governing organization. It's not a government regulator. It's a self-governing body of the four securities dealers, and that's one of the regulators that we deal with. So let's go right into this. Just press the wrong button. This computer is a little slow and takes a little longer to do things. All right. I wanted to show you a graph. Okay, talking about risk and return. Now this is a chart that gives you the annual average return between 1926 and 2008 on a whole bunch of different instruments. So this starts in 1926 going to 2008. The average rate of inflation during that time was 3% on average over that 82-year period. If you had invested your money in the money market, you would make 3.7 in bonds. These are it's 5.5. If you had a balanced portfolio of bonds and stocks, it would have been 8.1. If you had invested in small company stocks, it would have been 11.7. Now, what these have in common is that the ones on the bottom are less risky than the ones on top. Now you would say, well, but 5.5 and 11.7, that doesn't seem like that big of a difference. It's only a 5% difference. Just let me tell you something. If you had invested $1 in 1926, you had invested $1 in bonds, you would have had $80.66 in 2008. So that $1 would have turned into $80.66. If you had invested $1 in a small US company stock, you would have $8,716 in 2008, which is significantly more than $80.66, even though it's only a 5% difference in return. But it's the compounding. We talked about that the last time, the power of compounding where I earn interest on my interest. Now, man, this is a dollar that I never took out of the market. I put it in and I never touch it again. If I leave it in the stock market in the riskiest class of stocks, which are the small companies, I would have turned that $1 into $8,716. Now, if I had picked the wrong company, I might have lost it all at some point. That is a possibility. There's no free lunch. And this is not free, you get free pizza, you think, but you still have to listen to me. There is a cost to that. You can't just take your pizza and run. So there is nothing is free, and return or high return comes with high risk. And we'll talk about what some of these risks are. So what are the risks that we're facing when we're actually investing? There's all kinds of different things. Now the flip side of every risk is a chance. So whatever makes the value of your investment go down can also make the value of your investment go up. That's the flip side of it. So every risk comes with a chance, every chance comes with a risk. So there's interest rate risk. Some of these investment products that we talk about, some of these securities, change their value because interest rates change. They might increase in value, particularly bonds. They might increase in value, or they will increase in value when interest rates go down. They will decrease in value when interest rates go up. Interest rate risk is a very interesting risk because it's something that we can't control. It's one of those things where it's in the hands of the Federal Reserve. To a large extent, the Federal Reserve sets the boundaries for interest rates. It's not a market set process. Now, the Federal Reserve doesn't just pick those numbers out of the blue. They have some idea behind them. But they make interest rate policy. So this is something when the Federal Reserve decides we're going to have to change interest rates, they will change interest rates, and it's going to affect the market. And there's nothing that you can do. And it's not necessarily always very easy to predict. Again, all of these things, if you were to know how things go and which way they go, you wouldn't be sitting here. If I knew how it all works, I wouldn't be standing here. Happy, as I said, I would be enjoying the fruits of my labor somewhere else. But it's we don't. We don't know where it's going. Now, right now, with interest rates, it's fairly easy. They can only go one way. They can only go up. They can't go down where we are right now. Now, we've never been in that situation before. This is a, so right now you can be very smart in terms of forecasting interest rates. Where do you think interest rates are going to go? Well, they're going to go up. The question is when they're going to go up, and that's everybody's guess. So I can tell you they're going to go up. I cannot tell you when that's going to happen. Now, we know that what we hear from the Federal Reserve, it might not happen until 2013. It seems that they're going to be pledging to leave interest rates unchanged, at least until 2013. So that means there will be no change in interest rates then, which means there's not going to be a lot of interest rate risk in the next year, if we know that interest rates are not going to change. Obviously, there's always the risk that a business fails. That's why we need to do our research when we invest in a company, that we know that this company is actually going to survive. There's always a possibility. And when a company goes under, the company goes bankrupt, and I'm a shareholder of the company, I get nothing. That's really the simple truth of it. I get nothing. That's the worst thing that can ever happen to a shareholder, is that a company goes into Chapter 11 or Chapter 7, which are the bankruptcy procedures. There's no worse scenario for you. There's market price risk. The price of the investment, the market price of the investment drops. Now, some of these things are company specific, goes back to the business failure risk, or just the company not doing well. Some of it is broader, just the market in general goes up or down, the market in general varies, and every security that you own is going to be directly affected by that. And they normally move in the same direction as the market. Sometimes there are some outliers, but generally speaking, if the overall market goes down, pretty much all shares are going down. Some more, some less. If the market goes up, pretty much all of them go up, on average anyway. There's always some, if you watch the news and they're telling you, okay, that number of stocks went up today, this number of stocks went down today, depending on who they are, the market went up or the market went down. But on average, they all pretty much move with the market. Some less dramatically and some more dramatically. There's always inflation, losing purchasing power. It's great if my investment returns 10%, but at the same time, if my dollar loses 10% of its purchasing power, I have actually not gained anything. I have more money on paper, but it doesn't buy me anything anymore. And that's what it really comes down to. Because otherwise, it's just printed paper. It's the concept of being able to take that money and give it to somebody, and somebody's going to give you something in return for it. And that's what inflation comes down to. Now, the number one purpose of the Federal Reserve is to control inflation. That's the number one objective of central bank policy. And they've done a very good job. Give and take, that you cannot complain about the rate of inflation in this country. Now everybody can always complain, but if you compare it to other countries, we're doing very, very well in the US. You compare the US to other countries. Now, there are some countries in Europe that do just as well, in particular Germany and Switzerland, for example. But on the other hand, you have countries like Italy and Spain, for example, that before the euro had very high rates of inflation. You go down to South America, you're talking 10, 15, 20, 25% rate of inflation, which, if you just think about it, that means that every month your money loses a quarter of its value. Which is, it's very hard to grasp that concept. And when things like that happen, people just lose confidence in money and lose confidence in putting money away and lose confidence in banks. I had a grandmother who lived through two major inflations. She lived through the big inflation in Germany in the 1920s, hyperinflation, and then again through the inflation after World War II. She did not trust banks at all. She did not, she was very, very scared about losing all her money again, because it had happened to her twice. That people just were completely wiped out. So inflation is a big risk. And but again, we have things in place, we have mechanisms in place to control inflation, and so far the Federal Reserve has done a very good job in keeping inflation in check. Of political risk. Anything can happen in terms of tax changes, changes in tax laws, change in environmental regulations, whatever it might be, that might negatively affect one of the companies that you invest your money in. If there might be a business that now gets highly regulated, that increases their costs, so that's going to drop their profits, and that's going to have an impact on the performance of that particular business. That's why every major industry has lobbyists in Washington. That's exactly why they're there, because they don't want any regulation or anything that happens to their particular industry. That's why they're sitting there, and that's why they're lobbying. But it's always there. It's something that you always have to keep in mind. And then there's fraud. And we're going to spend a whole evening at the very end talking about fraud and talking about how you make sure that you don't get taken for your money, what are the warning signs, and so on and so forth. But there's a lot of bad people out there now that are just trying to get your money. And there's a lot of people out there that don't recognize that. And they're easily taken, and they hear all these promises about all these things that they can do for you. If it sounds too good to be true, it normally is. You give that all the time, but it's true. It is very true, and it's particularly true when it comes to investments. If somebody promises you to double your money in a week or in 6 months, you got to be very, very careful about that, because the chances of you doubling your money are much, much smaller than the chances of your money just going away. And that might not even be fraud, for that matter. That's not fraud. That's just somebody tells you, I can make you 100% in 6 months. That might be possible, in theory. It's not likely, but it's possible. Now, then there are other people that just try to fraud you with false facts, and making up companies and making up investments and things like that. So, gotta be very careful. Okay, now a financial market sounds like a very complicated thing. It works like any other market. It works like your farmer's market. It works just the exact same way. It's all about supply and demand. It's a very basic economic principle. If supply outweighs demand, the price of good will go down, and if there's more demand than there's supply, the price of good will go up. And that's not any different in the financial market. If everybody wants to buy stock in a particular company, that stock price is going to go up. If nobody wants that stock and everyone wants to sell it, the stock price is going to go down. And that's really all there is to it. That's how the market works. And there's no particular mechanism that guarantees you necessarily that when you want to sell something that you can actually sell it, if you want to buy it, that you can actually buy it. Now, in practice, if you want to buy stock, you can buy the stock. But theoretically, if you want to buy 100 shares of IBM and there's nobody out there in the market who want to sell it to you, then you can't buy it. It's really that simple. And we just never think about it that way, because we think about the financial market in terms of, well, it's just out there somewhere. If I just want 100 shares of IBM, there are going to be 100 shares of IBM. The only reason why there are 100 shares of IBM available for you to buy is because there's somebody else who wants to sell them to you. And if it's very hard to find that person, or they're really reluctant to sell them, then you're going to have to make them a better offer. And that's how this works, and that's how financial markets work. Now, financial analysts spend a whole lot of time figuring out what the fair value of an asset is. Now, what should be the price? What should be the price of that stuff? When you read things from financial analysts, they say, well, the target price is this, or it's overvalued, or it's undervalued. And these are all great opinions and great guesses. They all are guesses, because they are making these prices based on assumptions, based on what do I think is going to happen to this company. But the price in the market is not determined by what a financial analyst says. The price in the market is determined by how many people want to buy this particular investment and how many people want to sell it. That, at the end of the day, determines the price of this investment. And that's how it all works. And where do you do all this? At an exchange. Now, there's exchanges, in particular for the stock market. We have physical locations, although we get less and less of those. And we have computer networks. Really, the only stock exchange that we have left that's a major physical location is the New York Stock Exchange. So New York Stock Exchange still has a physical location. I'll give it 5 years, maybe 10 at the most, and that will be gone too. I mean, there's all kinds of movements around. Most of the trading on the New York Stock Exchange is already done electronically. It's not done by people running around on the trading floor. I mean, all those people that are on the trading floor, they're all looking for other jobs. Because it's just a matter of time before all of this is electronically, because it's cheaper that way. It's really that simple. That's what it comes down to. It is cheaper. People say it's more efficient. Not everybody necessarily agrees with that, because what you take out of this whole thing is seeing somebody on the trading floor, seeing the fear in their eyes, and it is something that people look at. If somebody, you can see somebody panic, you see somebody sweat, whatever it means, and you draw something from that. And that is information that you do not have when you communicate with a computer. Well, then it all comes down to just hard facts. You don't know what that person is thinking. And you can be deceived much more easily. Because traders have strategies. You know, professional traders have strategies. If somebody is working for a mutual fund, for example, and they have to buy or sell enormous amounts of stocks at a good price, again, the price is determined by supply and demand. And if I need to buy 1 million shares of IBM, because my portfolio manager tells me buy 1 million shares of IBM, I cannot go in the market and say, I want 1 million shares of IBM. Because if I want to go in and say, I want 1 million shares of IBM, everybody's thinking, what does he want with 1 million shares of IBM? He is the trader for this mutual fund. They must know something, or something is up. So, yes, you can get your 1 million shares of IBM, but I'm going to make it a little more expensive, because I'm not sure what you're up to. But I think you must know something. You think something good is going to happen to that stock, or you wouldn't buy like 1 million shares of it. So I'm going to make you pay a premium. Again, supply and demand. That's what it comes down to. So you're going to have to break it up. You buy 1,000 here, and 1,000 there, and 1,000 there, and that's how they do it. It is much more easily done electronically than when you have to do it on the floor, because it's the same trader coming back over and over again. On the computer, you're dealing on NASDAQ, for example. NASDAQ, which is kind of funny that the NASDAQ actually stands for the National Association of Security Dealers Automated Quotation System. Now, NASD, the National Association of Securities Dealers, is now FINRA. That's what NASD used to be. It's now FINRA. So it would actually make sense to now call it FINRAC, but they did not change the name. It's still called NASDAQ. It's a computer exchange. It's just a network of computer terminals. There are traders all over the country, and if you want to buy 100 shares of Microsoft, there's no physical location. It's just you call your broker. And that's the one thing. Everybody who wants to buy securities has to go through a third party. You can't do it by yourself. The only securities that you can buy directly are Treasury securities. You can buy those directly from the US Treasury. If you want to buy stock of any kind, if you want to buy corporate bonds, if you want to buy mutual funds, you have to go through a third party. You can't buy them directly. Some stocks you can buy directly from the company, but generally you have to go through a third party. So you go to your broker, and we'll talk about later how you pick those too. But you go to your broker, and that broker says, okay, I'm going to get you 100 shares of Microsoft. Now, Microsoft is a NASDAQ traded stock. So that broker is going to put an order in the computer saying, I want to buy 100 shares of Microsoft. And then there's going to be a whole bunch of people are going to put in bids and say, okay, I'm going to sell them for you for this price, and you get all these different prices. And by law, your broker is required to trade with the dealer that offers the best price. That by law, they're required to do that. If they don't do that, they get in trouble. And there have been brokerage firms that have gotten in trouble for doing that. When they get caught, they have to pay a fine to FINRA, and that pays for this. Now that's where money comes from. But that's not allowed. They have to give you the best possible price. They have to do that in NASDAQ to create investor confidence. Because otherwise, you don't know. If you don't know, if you cannot be sure that you get the best price, you always wonder, maybe there was somebody else who made a better offer. But I got this one. And so, because you as a third party, you cannot do this. Now, what you can do, and that's where things have gotten much better for the investor, you can get real-time prices now. Normally, if you turn on CNBC, for example, during the day, and you see that ticker running on the bottom, it says that quotes are 15 minutes delayed. The reason for that is because the New York Stock Exchange and the NASDAQ, they are not some sort of welfare institutions. They actually want to make money. They are for-profit organizations. NASDAQ, New York Stock Exchange, it's a for-profit organization. New York Stock Exchange, or Euronext, NYSE Euronext, which it's called, is a huge corporation, an international corporation. Does not only own the New York Stock Exchange, but also owns the exchange in London and Paris, and is now in talks to be merging with the German stock exchange to create the largest stock exchange company in the world. Now, there are some regulatory and some antitrust issues that they have to work through, but it is going to happen. So it's a huge multinational corporation. They need to make money. One of the ways they make money is by selling those price quotes. So if you want to get those prices real time, you have to pay for them. CNBC or CNN, they don't want to pay for them. After 15 minutes, they become public domain. After 15 minutes, they become public domain and they can be shown for free. So that's why, if you ever wondered, why are those quotes 15 minutes late? It's not because it takes 15 minutes for that information to actually get to them. It's because they cost money if they're less than 15 minutes old. They're not public domain until that point. Now, your broker might provide you with real-time quotes. You go to Yahoo Finance, they will provide you with real-time quotes, and the way they can do that is because they have all these ads on their page, and that pays for that. But that way you get to go to their page, and you can actually get real-time quotes, which is a good thing because you can compare the real-time quote with what you just paid for it. And that's how you would find out if you're taken for a bad price. And that's why they can do this, and that's why the market is so much more transparent than it used to be, because everybody can see what the dealers see. There's nothing secret anymore. Everybody has access to the same information at the same time as the people that work on the exchanges do. Just another nice piece of trivia, if it ever comes up, there's a Cincinnati Stock Exchange, which is a computer exchange. It was actually the first computer exchange in the country, and it's not in Cincinnati. So, it's actually it's in Chicago. But it used to be in Cincinnati, and then they realized most of their customers are in Chicago, so they just moved the whole thing, because all they had to do is move a computer network, moved it up to Chicago. So if it ever comes up, there is a Cincinnati Stock Exchange. It is not located in Cincinnati. And they never changed the name. Private companies are not traded on exchanges. So if you want to invest in a private company, it's a very different process. They're not listed on an exchange. They don't fall under certain regulations. If you're listed on an exchange, you fall under all the regulations we'll talk about later. If you're a private company, you're not listed on an exchange, which makes it very difficult for you to buy and sell those stocks. The nice thing about an exchange is, just like a farmer's market, the farmer comes to the farmer's market because the farmer knows that everybody who wants to buy fresh fruit and vegetables comes also to the farmer's market. Somebody goes to the stock market because they know everybody wants to buy stock, is going to come to the stock market. So if I want to sell stock, that's where I go. If I'm not a member of that stock market, if I'm not going to the stock market, if I'm a farmer who doesn't go to the farmer's market, then I'm going to have to drive my car around and knock on everybody's door and ask them if they want to buy some potatoes. And the same is true if I'm a privately traded company. If I'm a private company, I'm not an exchange. If I want to sell stock in my company, I'm going to actually have to ask people. And if I have stocks in that company, I'm going to have to pick up a phone and call everybody I know if they want to buy those. Because there's no central marketplace, which makes those investments a lot more illiquid. A lot of people, there are some companies where people buy these stocks for no other reason than because they can say their own stock in that company. The best example is just recently the Green Bay Packers, is not a publicly traded company, but they do have stock, and they just issued new stock. And that new stock, I think, was 20 million, 100 million, I forget how much money. It was an enormous amount of money. That stock sold within an hour. The interesting thing about that stock, it's not traded. It doesn't carry a voting right. It doesn't really, doesn't pay a dividend. It doesn't do anything. There's nothing that you get other than a certificate that says that you are a minority owner of the Green Bay Packers, which is very popular in Wisconsin. So therefore, they were able to, and that's not the first time they've done that. That's the second or third time that they've done that. And every time they do that, within an hour or so, they sell out the entire allotment. Because people just want to have that certificate. Because normally, by the way, you do not get a stock certificate anymore. You have to actually pay for it if you want that. But you know, they just want to have a stock certificate. They put on the wall, say, here, look at me, I'm a minority owner. It doesn't even give you any priority rights for season tickets, by the way. Not even that. It doesn't put you on the top of the list, or at least in the top 25%. Nothing. You effectively get nothing for that stock. But people just buy it. As I mentioned, you can invest online. It's very convenient. It's also very dangerous because you're not talking to anybody. Anybody can do it. If you know anything about it or not, you can lose a lot of money to a click of a button. If you buy some, you hear somebody tells you, oh, you should buy company XYZ. You say, sure, I can do it, no problem. So you go and you buy 1,000 shares of the company. You didn't do your homework, you just trust in somebody's rumors. And it's so easy to do. I mean, there's really, if you have a brokerage account, it takes all but 30 seconds to buy or sell securities online. And it's great, I mean, I love it. It makes it much cheaper too, because the transaction costs are much lower, because if you talk to somebody and you go to an actual person, that person is going to charge you a lot more. The computer doesn't need to eat, but that broker does. So, so therefore, the broker is going to charge you more for it. But at least, the good broker might tell you, well, maybe you shouldn't be investing in this, maybe this is not a good idea, or maybe this doesn't fit into your portfolio and your strategy, or what you're doing, and what stage in life where you're at, and things like that. You need to know what you buy. When you do it on your own, you need to do your homework. You need to know what it is that you buy. You need to know how the market works. There's all kinds of different things. There's all kinds of different kinds of orders that you can put in. We'll talk about some of these more. We'll talk about stocks and bonds in more detail. But there are market orders and limit orders, and you will see all these different things listed on the online service. Whether you want a market order or limit order or stop order or a stop limit or all kinds of difference. And you just say, I have no idea what that is. Don't know what it is. Don't just guess. That's not a good thing, and a lot of people do. And got to be very careful. So you need to know how the market works, and then you need to know your risk. Now you need to know what is it that I'm actually doing. How risky is this particular investment that I'm undertaking? So you got to be very careful when you go online. We already talked a lot about this. So I'm just going to skip over this. Stocks. You're owner of a company if you own stock. Every stockholder of a company is a part owner of the company. Your ownership might not amount to much, but that doesn't matter. You're still officially an owner of a company. So if you own a share of Walmart, you are an owner of Walmart. Now the company has 250 million shares outstanding, so that one share is not going to make much of a difference. Oh, by the way, I forgot just to give you an idea of how much trading is taking place on the New York Stock Exchange alone. There's about 1.6 billion shares traded every day. So so when I've talked about, there always needs to be a buyer for every seller and a seller for every buyer, and theoretically that might not happen. There's 1.6 billion shares traded every day. There normally is a buyer for every seller. And actually, at the New York Stock Exchange, there are so-called specialists. They are required by the rules of the exchange to be the other side of the trade. So on the New York Stock Exchange, if you want to sell stock, you will always be able to sell it. If you want to buy stock, you will always be able to buy it. The price is a totally different story, but you will always be able to make the transaction. On NASDAQ, it's not guaranteed. There's no guarantee that that transaction is going to happen. But again, NASDAQ's trading volume is about the same as the New York Stock Exchange. So there's so many people out there who want to buy and sell stock that it has never happened. It has never happened that a trade does not go through, that a trade is not being executed. And that would be a bad thing for NASDAQ too, that would happen. But it has never happened, but theoretically it's possible. Now there's different kind of stocks, common stocks, preferred stocks. Common stock is the lowest class of stock. It carries a voting right. In the order of preference, you are the very lowest level, meaning if a company goes bankrupt, there's an order of preference in terms of who gets money first. The common shareholders are at the very bottom of that food chain. Now, if a company had a lot of money, they wouldn't go bankrupt in the first place. So the people on the bottom of that food chain are not going to get anything. The preferred shareholders are just one step above the common shareholders in terms of precedence. Now, you get a voting right. You can get a dividend. You're not guaranteed a dividend as a common stockholder. The dividend is determined by the board of directors. They're not required to pay you a dividend. That's another thing. The dividend is not determined by the CEO of the company. It is set by the board of directors. Now, unfortunately, in a lot of US companies, the chairman of the board of directors is also the CEO of the company, which is kind of like against the idea behind that law, that securities law that says there needs to be a board of directors that's supposed to monitor management, and then you make the chief monitor also the company's head executive, chief executive. There is a slight conflict of interest there, but it's not against the law, and it's very common practice. It's common practice in more than 2/3 of companies in the US that the CEO and the chairman of the board are the same person. Now, things have gotten better in that regard ever since the scandals we have with Enron and so on and so forth in the beginning of this century. But there's still a large number of companies where the CEO and the chairman of the board of directors are the same person. But the board of directors sets dividends. They do not have to pay you a dividend if they don't want to. Now, a preferred shareholder has no voting right, but gets a fixed dividend. Now, that dividend is promised, but it's not guaranteed. Now, what that means is that they have to pay you at some point, but they can say, okay, I'm sorry, we don't have enough money to pay a dividend right now, so you're going to have to wait. Now, the way it works is that you cannot pay a dividend to a common shareholder until you have made up all the dividends that you owe to the preferred shareholders. So preferred shareholders get normally a fixed dividend. When you buy preferred stock, it might say like it's a 5% preferred stock, which means that you get a 5% dividend, 5% of the stock price is the dividend that you're going to get. That's what preferred stock does. Now, generally speaking, preferred stock is a good investment if you don't pay taxes on dividends. Now, there was a time when we didn't have to pay any taxes on dividends. Now we do have to pay some tax on dividends. We're still taxed less on dividends than we're taxed on interest income, so that makes it a better income stream. When the tax rates were the same, there's really no reason for an individual investor to buy preferred stock. Preferred stock is bought a lot by institutional investors because they get a tax break on preferred stock, up to 80%, depending on what kind of company they are. So, as with anything, there are a lot of tax implications when it comes to investments. There's a stock price, obviously. Whatever you have to pay for the stock, it is determined by supply and demand of the stock. Again, the dividends, they're paid quarterly normally. They are declared, and then there's a hold of record date that they'll tell you. At that date, you need to be a shareholder. You need to be on the shareholders list. If you're not on the shareholders list on that, what they call the hold of record date, you will not get the dividend. Now, what will happen is that at the hold-off record date, the stock price is going to drop. And it's going to drop by about 75% of the dividend payment. And the reason for that is because everybody who buys the stock after the hold-off record date is not going to get that dividend, so they're going to lose that payment, and that's why they're not willing to pay for that extra payment. That's how the stock is going to adjust. Now, it's going to adjust by about 75% of it because dividends are taxable. And on average, it's going to be about 75% drop in the stock price. So when you own the stock and you get the dividend, and then the stock price drops, there's no reason to be worried and say, oh, what happened to the stock? You get a dividend or the stock price went down. That is just a reflection of the fact that you just got a dividend. Now, that is a natural thing that's going to happen every time you get a dividend, and it is no reflection on the performance of the company. That stock price is going to go straight back up after that, but first it needs to reflect that there is a cash flow taken out of the stock, that the owner that buys the stock after the hold-off record date is not going to get. Now, the dividend might be, by the way, paid 2, 3, 4 weeks later, but you need to be an owner of record at that particular date. And they will tell you, when they make the announcement, they will tell you what the owner of record date is, the holder of record date is, and what the actual payment date or distribution date is. They're not the same. The payment might come later, but you need to be a holder of record on that date to get the dividend. And the dividend is paid normally to your broker, and then the broker pays it off to you. The way this works is that in order to speed up the whole process of buying stock, it used to take 3 to 5 days to buy stock for an actual transaction to clear. And the reason is because everybody's name was put in the shareholders list. Now what they do is they just put the name of the brokerage firm in the shareholders list, and then the brokerage firm keeps a list of all the people that bought the stock. So you might notice that when you get, if you own stock, if you get material from the company, like the annual report, the quarterly report, it's always been sent to you by the broker. It's not coming directly from the company. That's because the company doesn't know that you're a shareholder, but the broker does. And so all of this information comes to you. You are entitled to go to the shareholders meeting. Just owning one share of stock entitles you to go to a shareholders meeting. These are extremely boring if there's nothing happening in the company. They are very interesting if the company is in turmoil. They are very interesting. I've been to some very interesting shareholders meetings when there are companies that are having some trouble, and because you're entitled to speak too. Every shareholder is entitled to go up to the podium and put in their 5 cents, and they do. And it's very interesting. It's very interesting. And but other than that, unless you like a lot of free stuff. When I was a graduate student, I owned some Procter & Gamble stock, and I lived in Cincinnati. And I would go to the annual shareholders meeting because I would go home with enough cleaning products and toothpaste to last me 6 months. Because of all the stuff that you could, all the free samples that they had sitting around there, and you could take them all with you. So that was worth it. And they fed you too. So. Different kinds of stocks. Now, I don't know if you can see this. There's different types that you have it on the list too. There's mega, large, mid, small, micro, and nano. The difference is in market capitalization. Market capitalization is a term that expresses the number of shares outstanding multiplied by the stock price. So if you take the number of shares that a company has outstanding and you multiply it by the stock price, you're going to get the total market capitalization or market cap of the company. In terms of market cap, and it kind of switches by day, we're talking about the 3 largest companies in the world are Apple, Microsoft, and Exxon. Those are the 3 largest companies in the world in terms of market capitalization, which is it's very remarkable as far as Apple is concerned. Because in the early 90s, that company was about this close to being dead. Now they actually surpassed Microsoft. I think that was the biggest joy for Steve Jobs before he passed, that he actually was able to get past Microsoft, because Microsoft did everything they could in the late 80s and early 90s to get Apple off the market, and that he was able to come back. But these are the 3 largest companies. The mega cap, those are your blue chip, also known, same as your large cap. Those are your blue chip stocks. There's very little risk of failure, really, unless it happens over time and you have a product that is kind of going out of style, or you're not keeping up with technology. There again was news in the paper today about Kodak probably going bankrupt. Now, that's a company that's obviously been around, and if you had asked somebody 30 years ago if Kodak could go bankrupt, everybody said, wow, how would Kodak ever go bankrupt? They kind of missed that whole digital revolution, and they were just not quick enough to adjust their business model. And it was the biggest thing when they stopped, I think it was just 2 or 3 years ago, when they actually stopped accepting film rolls. There was like 2 or 3 years ago, there was a big thing, and there was even a special on 60 Minutes, I remember that, because Kodak stopped. Like the whole Kodachrome thing stopped. They were not accepting any rolls of film anymore. Because, nobody uses those anymore. But they were never able to actually get into the digital market, and they're going to go away. And this is not a company that's going to survive. Now, they are going to go away. There's no doubt in my mind that somebody's going to buy the pieces, and the name might somehow survive. Well, might. The thing is, you have to be very careful when companies go bankrupt with the name, because the name is part of the bankruptcy. So the name is being auctioned away. Like Circuit City went bankrupt. The name Circuit City is still out there. If you look at your email, maybe somebody get an email from circuitcity.com. That is not the Circuit City that was around 2 years ago, 3 years ago. It's somebody who, in the bankruptcy, in the liquidation of the company, bought the name and uses it to sell their products. Because it's a name everybody remembers and thinks, oh, that gives you, immediate credibility. And you got to be very careful. That is not the same company. They just bought the name in the liquidation. And things like that could happen to Kodak as well. And then you go down. Obviously, the smaller the market cap, the riskier the company. The company was less than $50 million in market capitalization. It's a very small company, and $50 million sounds like a lot of money. Is a lot of money. For a publicly traded company, it's not. That's not a lot of money for a publicly traded company. So these are very small companies. It's a highly risky investment. The same is true for microcap and even small caps. As I said, the highest return that you would have earned in the stock market over the last 80-something years would have been in small cap companies, much more than a large cap. A growth stock is mostly a small micro nano cap stock that has high growth potential, where the company is still young and grows in normal double-digit figures. Again, it's very high risk because it could grow too fast. That has happened to a lot of companies. There's another company that's having some troubles and had some troubles before, which is Kmart. Kmart went bankrupt because it grew too fast. It could not actually finance their growth. They took on too much debt when the growth stalled. They had too much debt. They couldn't pay their debt anymore. They were taken over by Sears. Now Sears is having all kinds of troubles too. So there's another, traditional U.S. company, Sears, that is in some trouble right now as well. Not for the first time, for that matter, but they're in trouble again. So growth stocks that grow at a very high rate, it's a high risk, but high reward also. Income stocks are stocks that pay a high dividend. Your utilities company. What you want to get from a stock, if you want to get income from a stock, you need a stock that pays a high dividend. It has a history of paying a high dividend, what they call dividend yield, which is percentage relative to the price of the stock. Now, like you said, a 5% dividend yield means that the dividend equals 5% of the stock price. That would be an incredibly high dividend yield. A company that pays a 5% dividend yield, that is certainly an income stock. Utilities are your prime example of an income stock. They pay traditionally very high dividends. So if that's what you're looking for, that's the stock you want, a stock that pays dividends. By the way, a growth stock is normally not going to pay a dividend because they need all that money to reinvest to continue to grow the company. Income stock companies are normally old companies that don't grow much anymore, so they do not reinvest a lot of their money in the operations. Or in the case of utilities, there are actually regulations that force them to pay out a certain percentage of their profits to their shareholders. Most companies do not have to do that, but regulated utilities in particular do have to do that. Some of it has to do with the monopoly structure that they have, that they don't really have much competition in the individual markets. Blue chips, those are, your Dow Jones 30 big companies, stocks that you think of when you think about large US companies, think about ExxonMobil, you think about IBM, you're thinking about Apple, Microsoft, GM used to be one of those. They ran into some trouble. But those are the companies. Procter & Gamble is another one. Dow Chemicals is another one of these large US companies that have been around for a long time, multinational corporations. Those are your blue chips. And most of the time, you really can't go wrong with those companies. So the chance that these companies are going to go under and that you're out of your money is very, very unlikely. You might not also get a very high return on those investments because they are already grown to most of their potential. They're still growing. A company that doesn't grow anymore, from a shareholder's point of view, should not be around anymore because it can't make you any more money. But they all grow, but they don't grow in large numbers and large double-digit numbers. And then there are value stocks, and those are the ones that everybody's looking for. And they're the most difficult to find. Those are the ones where you make an analysis, or a financial analyst makes an analysis of a company and says, well, this stock, in my mind, is worth $20. And then you look in the stock market and you see that the stock is trading for 10. Then you're seeing a stock that the market only thinks is worth $10, but you in your mind think it's worth $20. So there's a $10 difference. That for you is an undervalued stock. In your mind, in your opinion, it's an undervalued stock. So you would buy that kind of stock. That's a value stock. That you think is diamond in the rough, the stock that nobody has found yet. These are incredibly difficult to find because we assume that markets are mostly efficient so that all information is available to everybody. And the problem is most information is available to everybody. In order to outperform everybody else in the market, for the most part, you need to know something that nobody else knows. And if you trade on information that nobody else knows about, that's insider trading, that's illegal. So you can't do that. But sometimes you find them. Those are smaller companies, off the beaten track, companies that are not followed by so many analysts, that are not in the news so much, that just investors have not discovered. But they're hard to find. But those are the best investments. If you find a value stock, that's where you make your most money in the stock market. But everybody's looking for those. Bonds. Interesting thing about bonds. When people think about a bond, they think about a treasury bond or a corporate bond. That's the one thing. You've got to be very careful with bonds. It's kind of like if I told you I have a cat, you would not expect me to have a tiger. But a tiger is a cat. If I tell you I buy bonds or I sell you bond, you would not expect me to sell you an asset-backed security. One of those securities that caught us in all this trouble, something that's called a collateralized debt obligation. Most of you say, what in the world is a collateralized debt obligation? Somebody will tell you that's a bond. And theoretically it is. By pure definition, it is a type of a bond. But your normal investor, when they hear a bond, they think a treasury bond or a corporate bond. Just like when you hear cat, you think house cat. You do not think tiger. And that's the same thing. You've got to be very careful. And there's a whole bunch of lawsuits going on with bond funds in particular that were selling people bond funds. And again, on paper, those are bond funds. But investing most of their money in really highly risky bond-like securities that nobody really understands, including the people that were investing the money in it. And that got them in a lot of trouble. Morgan Keegan being the main culprit in this market. They had bond funds that lost 95, 98% of their value because they were investing money in what they're called bonds. And again, you can look up a definition what a bond is, and you will find all these different kind of bonds. But if you read it, you think bond, okay, that sounds safe, and you know, it's an income security, I should be fine. They are far from it. It's a very different animal. So you have all these different kind of bonds. The bond price changes with interest rates. Interest rates go up, bond price goes down. Interest rates go down, bond prices go up. It's a loan. It's nothing else. It's a loan. It pays you an interest, normally every 6 months, and it pays you the principal back when the bond matures. That's how a bond works. But you can buy and sell that bond at any point in time. You're not married to that bond until it matures. You can sell it when you think it should be sold. Municipal bonds is bonds that, that local governments give out. And this is Jefferson County. So we're all familiar with municipal bonds. And what can happen? Treasury bonds are issued by the Treasury, obviously. Federal agency bonds are issued by federal agencies like Fannie Mae and Freddie Mac, FHA, Ginnie Mae. They don't, Fannie Mae and Freddie Mac, they might not have a good rep, but these are safe. They did not default on any of their bonds, and that's because they're backed by the government. Government agency bonds or federal agency bonds are just as safe as Treasury bonds because they are still backed by the full base and credit by the government. The Tennessee Valley Authority is a federal agency. They issue bonds, for example. They are safe. Then there are corporate bonds. Those are basic corporate, corporations that need a loan. Instead of going to a bank, they go to the financial markets and they just issue bonds and they sell loans in the market. Asset-backed securities. Those are your mortgage-backed securities, credit card-backed securities, car loan-backed securities, equity, home equity loan-backed securities. There's a whole array. I'm teaching a class at UAB about the bond market, an entire semester. I can spend an entire semester to go over the different classes. Nobody thinks about the bond market. It's one of these things. The volume, the trading volume in the bond market is about 10 times of what the stock market is. There's a lot more going on in the bond market than the stock market. The bond market is what got into all this trouble. It was not the stock market. Nobody ever thought about the bond market until we got in the financial crisis. That's all of a sudden when the bond market kind of came to the forefront. Not in a good way, but it came to everybody's mind. But it's a very complicated. These are highly complicated securities. These asset-backed securities, there's a whole array of them, can be highly complicated, highly technical constructs. It's very difficult to calculate a price and all these different scenarios, default scenarios, and so on and so forth. And as a general rule, I would really tell everybody to stay away from them. Now, a Fannie Mae or Freddie Mac mortgage-backed security, there's nothing wrong with those. There's nothing wrong because they're guaranteed. How an asset-backed security works is there's a pool of an asset. In the mortgage-backed security, there's a pool of mortgages. And then the person who owns all these mortgages issues securities and says, okay, I sell you this security, and in exchange, you're going to get, whenever somebody makes an interest payment or a principal payment to their mortgage, I'm going to pass it on to you. That's how it works. The problem is, if somebody doesn't make the mortgage payment or doesn't make an principal payment, I have nothing to pass on. And that's when these things fail. Now, when you buy a federal agency security, these are guaranteed. The Fannie Mae and Freddie Mac will guarantee you the payment of the principal and the interest. That's why Fannie Mae and Freddie Mac got in trouble, because they guarantee the payment of their bonds, but their pools were not performing. So that's why they have all these enormous amounts of financial problems, because they still needed to service their bonds, their debt, but their source of income wasn't coming in. But we need Fannie Mae and Freddie Mac to issue mortgage-backed securities, because the only reason, I just looked it up this afternoon, the only reason why we have a 3.75% rate on a 30-year fixed-rate mortgage right now, 3.75%, which is ridiculous. 3.75%, everybody should be running out and buying a house at this point. 3.75% is because Fannie Mae and Freddie Mac buy those mortgages and then they can sell them in the market to somebody else. That's the reason why we have low mortgage rates. That's the only way. A bank would never hold a 30-year fixed rate mortgage. It makes no sense to put an asset that creates a 30-year fixed rate payment on the one side of the balance sheet So you're going to get from there a fixed payment, but you have to finance yourself. The money that you need has to come from much shorter term investments, and therefore you have all this interest rate risk, interest rates going up and down, and you only receive a fixed rate payment. You would not take that risk as a bank. You don't take that. That's why you want to get rid of those, and that's why you're so happy that you can sell them to Fannie Mae and Freddie Mac, and that's what keeps mortgage rates low. So we do need asset-backed securities. There's nothing wrong with asset-backed securities per se. But there's a whole bunch of them out there that even the people that issued them, I don't think, understood exactly what they were actually issuing. Yeah. Treasury bonds are considered risk-free. There's no risk of default. That's the main risk in the bond market is default. That whoever issues that bond is not going to be able to make payments. That they go bankrupt. The government has never done that. They're considered risk-free. All the other bonds in there have certain levels of default risk. Now, federal agency bonds do not really have default risk either, because the federal government says that they're fully backed up. There's no law but like Fannie Mae and Freddie Mac, for example, the government it was always implied that the government would bail them out if something bad would happen to them. The government did not have to do that, but it was always implied in the market that they would, and as it turned out, they did. So, and that's why these securities are as safe, or almost as safe as treasury securities. But corporations can go bankrupt. You have an asset-backed security, that pool of assets that backs that security might not perform. The loans that are in that pool might not generate any interest payments or principal payments anymore. Again, this might be mortgages, this might be credit cards, this might be car loans. You would be amazed that every loan that you get, you can be pretty sure that within a few weeks that loan is going to be gone and sold to somebody else, and then being sold on to somebody else. You never know because you just keep making the same payments to the same person. But I would assure you that I would say about 95% of you have a mortgage that is probably not with the bank or the mortgage bank that you think it is with, or that you send the check to every month. Because they just sell them on. But they keep servicing them. They charge Fannie Mae and Freddie Mac for that, so they actually bank makes money with that. And they sell you the bill, send you the bill, they take the money and pass it on and keep a percent to themselves. So you will never know. But you can be pretty sure if you have a conforming mortgage, meaning less than $400,000, $409,000 to be precise, that it's going to be owned by Fannie Mae and Freddie Mac. Again, from a banker's point of view, it doesn't make much sense to keep it. Quoted percent of face value, what that means is the face value is the principal of the loan. It's normally $1,000. So if somebody says the bond price is 97, that means it's trading at 97% of face value. That would be at a face value of 1,000, it would be $970 that you would have to pay for that bond. They're traded in an over-the-counter market, which is not an exchange. There's no bond exchange. It's not working like the NASDAQ or the, actually NASDAQ is an over-the-counter market too. It doesn't work like the New York Stock Exchange. So if you buy a bond, your broker's going to have to call somebody or put it in their call really anymore. They put it in the computer terminal, asking somebody if somebody's willing to sell that bond. But there's no exchange, and there's very little transparency. You can look up bond prices. As a matter of fact, you can't really look up real-time bond prices. Unless you have a Bloomberg terminal, which costs you about $20,000 a year, so you probably don't have that. Otherwise, there's no real-time price quotes for bonds on the internet. Not for free, anyway. So it's not a very transparent market. But mutual funds, probably the one thing that all you ever will need. Will spend an entire session next month on mutual funds. So I'm just going to go over just, this is, for most investors, that's all they need. Because somebody else, you do not have to actually make an analysis on every individual investment, every individual security that you buy. It's a matter of, I have a certain idea what I want to have, what I want to be invested in, and then I have a portfolio manager and that has a good track record that I can trust, that they're making the right decisions. That's what a mutual fund does. You want to stay away from those altogether, but just to let you know what they are, because sometimes people come to you and want to sell them to you. A derivative is an asset, that's what called derivative, that derives its value from the value of another asset. These are things like futures and options. You might have heard about those. You might have heard about, like, for example, frozen orange juice futures, pork belly futures, wheat, oil. You know, there's futures on gold, silver, on all commodities. They're called commodities. They're traded. You can buy those. I would, again, advise you against it, but you can buy those. And if, like, say, you buy an orange juice future, and then, which means that you buy something, if you buy it today, let's say it has a 6 months maturity, that's like 6 months from now, you're going to have to actually deliver orange juice to somebody. Now, unless you sell it before the 6 months are up. But if you buy a future now, you basically say, okay, I'm buying orange juice from you. You're selling me 1,000 gallons of orange juice. And I bought that right from you. Now, if now all of a sudden there's frost in Florida that we just had the other night, and everybody says, oh, the oranges are not going to do well, there's going to be a very bad orange harvest, obviously the price of oranges is going to go up. And so will the price of the future. And then you can sell at a higher price, and you could make a lot of money. Enormous amounts of money. At the same time, it could happen, well, guess what? We want to get the best harvest ever. And we're going to have more oranges than anybody can ever eat, drink, or do whatever else with. So the price is going to drop. And unlike a stock, for example, I say, well, maybe I can just hang on to it and wait for it to go back up. That future is going to expire. And if you do not sell it until the 6 months are up, or whatever the expiration date is, you're actually going to have to buy 100,000 gallons worth of orange juice. It's going to be delivered to you. So you got to be very careful with commodities. There is an actual there's an actual good attached to that. Now it's a very complicated market. It's a very interesting market. This is an actual floor market still. There's a lot of floor trading still going on. It's going out of style too. But they're actually doing pit trading, so they're standing in a big trading pit and they're yelling at each other and they're doing all the signals and all that kind of stuff. Before 9/11, you could go to all of these exchanges. Now you could go up to Chicago. Chicago is kind of like the biggest derivative exchanges are in Chicago. Chicago Mercantile Exchange, Chicago Board of Options Exchange. And you could go up there to the visitors gallery and you could watch people down there going crazy. Unfortunately, you can't do that anymore. They don't let anybody in the buildings anymore, which is very unfortunate. But